Canoe EIT was for many years the favorite fund for passive income investors. Well, times have changed a little, and now the total return folks are starting to take a look at Canoe. Fasten your seatbelts, folks. This is going to be a good one. Canoe EIT as an income fund is quite interesting in that it shares properties of both a company and, of course, an ETF. This fact can make them a very interesting company to look at for sure. They have in the past been a huge favorite for passive income investors, as well as a stock many growth and total return investors have flirted with. It is not surprising, as they have been a reliable source of steady income with enough growth to move them onto the total return scales. If you look at them over their entire inception, they've actually done quite well. This graphic shows how much you could have made with a single $10,000 investment in 1997. That, of course, was the year of their inception. So today, if you had made that investment, you would have $113,204, which is not too, well, it's not too shabby. I do note that almost half of the growth of that initial investment has been since 2020, so they seem to be picking up for sure. I do want to talk briefly about fees, as some folks, especially on Reddit, love to get on Canoe's case about the high management fees. They are right in that Canoe does have a pretty steep fee, and that is exactly why they are so well managed. So their management fee is stated at 1%. Which is notably on the high side. However, when you dive deeper, you will find that they have a very high management expense ratio. In fact, when all is said and done, it comes in at 2.08%. Holy banana bread, that is certainly enough to get Reddit in a tizzy. One thing you must remember is that this high management expense ratio is a fee that is already deducted before the company even declares their dividend. So they don't come back later and charge you then. The yield you see is the money you get. So if you are okay with the numbers that are hitting your portfolio, then the fees are really not that bad. Mind you, if you find a similar fund providing you with less fees for the same value, then yeah, sure, it does make sense for you to make a change. Join today's conversation. Let me know in the comments if you currently hold any Canoe. Thank you for your participation. If you love this sort of content, be sure to hit that subscribe button for more, and another huge thank you for that click. Before we get into the numbers, I do want to take a moment to look at diversification, as it is another strong point for Canoe. When I said that Canoe acts as an ETF, well, that is because they invest in a pretty diverse basket of stocks. This graphic shows you the sector diversification, and you will see they are heavier on financials with a very strong showing from industrials, energy, and healthcare. When we look at their overall investment geography profile, Canada comes in with 47.4%, the US very close with 46.6%, the UK with 4.3%, and Switzerland with a wee 1.7%. Wonder if they invest in like Swiss watches. I don't know. The fund also holds a small 0.7% stake in fixed income that can also change depending on the market conditions. Let's take a quick look at their top holdings. I will admit that I was a little surprised to see American Express at the top, but I do overall like the mixture of companies I'm seeing here. Of course, as this is an actively managed fund, these holdings can and will shift around a wee bit to ensure they are still meeting their overall growth and, of course, income goals. Wow, I kind of feel like we have already begun the deep dive, but there is no way we would do that without first calling on the master of number crunching, the one and only Mr. Math. Let's start off with a little surface data. Their current value at the time of recording comes in at $15.55. They have a market cap of $2.40 billion, and they have a beta that's just a little bit more volatile than the market average at 1.19. Their earnings per share come in at 0.74, and their price to earnings ratio, they come in at 18.39. The average amongst their peers come in at 10.5. A few of those peers include Brookfield Asset Management with a PE ratio of 18.61, Wilmington Capital with a PE ratio of 16.17, and Sprott with a PE ratio of 22.02. Their price to book ratio, that comes in at 1, and the average amongst those same peers comes in at 0.8. When we look at their return on equity, that comes in at 5.56%. I would actually like to see that a little bit higher. The return on assets comes in at 3.37%. For the most part, these numbers are fine. I would, of course, like to see both the ROE and the ROA a wee bit higher. Okay, let's peel back another layer and take a gander at Canoe's cash situation. So their revenue comes in at $148.57 million, and those earnings come in at $124.73 million. Their profit margin, nice looking 71.34%. This is really high, but it is that business model where there is a lot of overhead. So this is a statistic that tends to be on the high side for sure. Their free cash flow, it is in the negative $112.77 million. Operating cash flow, exact same number, negative $112.77 million. With their high dividend, this is just a reflection of them paying that out. The reality is that the dividend does eat up their earnings, and then some. No worry though, this is how that fund is structured, so it is actually normal for them. If we want to take a look and see what their fair value is currently, their current value, of course, we mentioned it before, $13.55. Their fair value using a discounted cash flow model comes in at $22.42. So it does paint them as being undervalued by 39.7%. Overall, the cash situation is fine. This is a fund that, it's structured to provide income, and these numbers are reflective of that. So let's dive a little deeper and take a look at their returns. They have a dividend yield of 8.876%. It is a monthly dividend of 10 cents per share. Their payout ratio, it is high, 162.16%. This payout ratio has gone up quite a bit. But for it being unsustainable, it depends how you look at it. One thing you need to realize with Canoe is that it is a fund that employs return of capital, or ROC, to help pay out those dividends. ROC on a tax scale helps Canoe pay less taxes as they pass them on to you, much like a REIT. You want to hold Canoe in a registered account, so you are not paying those deferred taxes in the form of larger capital gains. Canoe does also have the option to leverage some debt to pay those dividends, but I do feel it is more of an ROC show, and we'll see that once we get to their debt. Switching over to look at the actual returns. On the 3-year, their price rose from $11.35 to $13.55. That is a return of investment of 19.38%. Once we factor in their nice dividend, we get a total return of 51.10%. That is not bad, and you can see that more than half of that return is from those dividends. On the 1 year, their price rose from $12.61 to $13.55. That is a return on investment of 7.45%. Factoring the dividends, we get a total return of 16.97%. And so far this year, year to date, they have a return on investment of 4.96%, a total return of 7.28%. The returns look good, and I can see why they are becoming a stock people are talking about. We have one last dive as we push into their debt situation. They have a total debt of $316.65 million, and their total equity, that comes in at $2.32 billion. That places their debt to equity ratio at a nice looking 13.6%. I said earlier that the debt was going to tell us a tale about how sustainable that dividend is, and it really does. This debt to equity ratio has come down 13.6% over the last 5 years, as it used to be 29.4%. What this is telling me is that they are reducing debt and not using it to pay those dividends. So it looks like the return on capital, so that ROC, is the driving force of their dividend sustainability. That's a good thing. They also have cash and cash equivalents of $14.77 million. All right, let's take a look at their short term. On the short term, they have assets of $20.83 million and liabilities of $117.64 million. So I'm not crazy about that. On the long term, their assets come in at $2.64 billion and their liabilities come in at $220.66 million. That looks a lot better. Overall, this is a good debt situation. It is manageable and does provide a buffer for dividend sustainability if they were to need it. Oh, and the interest on that debt is well covered by their earnings before interest and taxes, or our good old friend EBIT. It is time to ask that question. What is my final verdict? I still am a big fan of Canoe, and currently it has about a 10% stake in the 0 to 100K challenge TFSA. So as usual, you always want to factor in that bias that I possess for Canoe when you listen to this verdict. Canoe has been consistently paying a 10 cents per share dividend for a long time. They are well managed, and that is easily proven by the fact that the dividend, well, it keeps coming even in the worst parts of the bear market. Their fees are high, but maybe they are worth the stability that comes with this fund. If you are a passive income investor, This is a stock for you. We are talking about reliable dividends that you can mostly just drop into your TFSA and leave them alone, and maybe think about them once a month when that dividend rolls in. If you are a growth investor, this may not be the best choice, but it may still be worth looking at. The consistency of the dividend, even with meager growth, is not a bad total return. It is also well diversified, which can be another plus for your portfolio. For a total return investor, this is still a good stock to get in on when there is a correction, so you can ride up the returns and enjoy the growth with those dividends. This can be a great addition to a total return portfolio, even if it is just to reinvest the dividends into a Hammond stock or whoever the hot stock of the day is. Whatever type of investor you may be, if you are holding Canoe, enjoy those great dividends and be sure to avoid the potential taxes by holding it in a registered account. If you are interested in Canoe, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on ENCC. Thank you for watching, and I will see you in the next video.